Program.
Warm welcome to all of you. This is AKS Nari from Smart VRC Bhopal. And today we have got a very interesting topic. This is webinar number 105. Almost 13, 14 months have elapsed when we started with the online, I can say, the seminars. Earlier we used to visit city-wise and conduct seminars and workshops, and now the same is being communicated through the webinars. How to protect profits? When I say profits means you all will agree during last more than 1 year, Sensex is up by 100%, and I assume majority of us are sitting on profits of at least 100%, and many of us are worried that whether we shall be able to move ahead from here in terms of creating more wealth, or we have to take care of our profits, we should book profit, and there are many questions in our minds. Some are thinking that market may go up, some are thinking that market may go down, and we at Smart VRC are not at all worried about the market. We are very much worried about the stocks. But there are ways to protect your profits, and let's see how these are possible. So starting with a poll, and the poll is, at least in one of the stocks, you are sitting on huge multi-fold profits. Is it true or not? So let's see how many of us are sitting on such stocks. So the question is on your screen. A very interesting results I'm going to share. I'm very happy that within first 15 seconds, 71% attendees have voted, and I request all of you to kindly participate in this poll. This is going to be very interesting. Yeah, 10 seconds more. I request all of you to please participate. Well, here are the results. 78 participants agree, and they say, yes, we are sitting, at least in one of the stocks, we are sitting on huge multi-fold profits. And naturally, many of us are sitting on more than one stocks. And that is exactly why we have taken up this topic. Thanks for participating. So how this idea came to us? Actually, it happened that last week I received a phone call, and he is not our subscriber, and he said that he is very much worried about his profits, and he is not able to decide what to be done. He has created huge profit, and he is worried because the kind of stocks he is holding, he is not confident, he is not convinced. Now that is very interesting. He is holding the stocks which he himself knows that are not that fundamentally sound, that they should command such a premium in the market, but still he is holding it. So that is a kind of a fear that something may wrong happen, and with the market or with the stocks he is holding, and someday he may lose part of those profits. There is a fear of losing the profits. Some are fear of losing. Some have the fear of losing a great bull cycle. Some are sitting on profits and they are having a fear of losing part of those profits or maybe the whole profit. So that is how we have come to this topic, and it is going to be pretty interesting, I'm very sure. So what we are going to have in this webinar in the coming 40 or 50 minutes is the 4 ways to protect your profits, to be followed by question and answer session. That is going to be very interesting as usual. So the first is stock-wise allocation. How much you have made the allocation of a single stock to your portfolio. I should show you through an example. Suppose there's the portfolio and portfolio of stocks, as you can see with the as you can see, these are the stocks, these are the company names. I have shown here only about 9 companies, but we recommend normally about 16 to 18 companies in a portfolio. So this is just for an example. And suppose there is a stock with the name of A, and it has a weightage, it had a weightage of 4% maybe about 6 months ago. And what has happened is today its weightage has increased to 9% because this stock has gained much more than the rest of the stocks, and as a result, the weightage has more than doubled from 4% to 9%. Now it is very natural. There was some consideration when you included this stock in your portfolio based on the risks and returns associated with that stock, based on the prospects of that stock, based on the maybe the size of that stock, maybe the kind of risk you assessed at the time of including in your stock. Now that weightage has increased from 4% to 9%. It is very natural if the story has not bettered during this duration. If the story is as it was at the start of the this portfolio, I mean to say when you included this stock in your portfolio, if the story is same, then why should it be allowed? Why should the weightage be allowed to increase to more than 100%? Naturally, you should reduce the weightage, and this should be followed for each and every stock. आपके सभी stocks में आपको एक एक stock को देखना चाहिए कि किसका कितना weightage है. Does it deserves? Over a period of time, it happens that the weightage is increased because of the unproportionate rise in the share price, and that is how you can protect your profits. So that was one of the ways, a very simple way, but very effective. Then comes the strategic allocation. What is strategic allocation? When you start a portfolio, there is a strategy. You have defined the strategy that how much allocation you are going to make to the stocks, how much allocation you are going to make to the gold, and similarly to debt, and similarly to real estate. There is strategic allocation. So suppose it is like this. In January 2020, you allocated 20% to equity, right? And then gold occupied 14% normally. We also recommend that gold should be there in your portfolio about 10 to 15%, and debt about 14%, and real estate 32%. Now, from where we got this allocation? It is just using a thumb rule that the equity investment should be 100 minus your age. So suppose there is a portfolio of a person with a age of 60 years. So his equity proportion was 40%, and rest of the assets were like this. Only 4 assets in his portfolio. And that is, when I say portfolio, means asset portfolio, not the equity portfolio. This is total broad asset portfolio. So in an asset portfolio, 40% was in equity. That was in January 2020. That is just the beginning of COVID. In fact, we were not aware that it's going to take such a critical situation, that we are going to have even a second wave. So it was under very normal circumstances, and that time the index was hovering around 41,000, I believe. something about BSE Sensex was 41,000. So that is in January 2020. Now what happened next? Come April 2020, as we all know, market started falling, especially in the month of March. Till 23rd March, there was no chance, no sign of any U-turn or anything like that. And 23rd March proved to be the bottom of the market. And in April, the equity portfolio was down to 25%. So the weightage of equity, which was 40% in January 2020, fell to about 25%. This is just an assumption. Okay, this is just based on the proportionate fall in BSE index. So equity portion, which was 40% in January 2020, fell to 25% in April 2020. So and for the rest of the assets, I have assumed that their price levels are the same. But since the equity proportion has reduced, it is but natural that their proportion will increase on a proportionate basis. So this is the new asset portfolio in April 2020. So in April 2020, it is just a repeat of the last slide. And now coming to the today's scenario. Today's scenario, June 21, equity has again increased to 51%. So that investor has not done anything, that has not tinkered with the equity investments, and he is invested in BSE Sensex just for the assumption. And we have seen that the equity which fell down to 25% and now 51%. And we also know that during the last week of March and first week of April, and if you compare with the today BSE Sensex is up by almost 100%. I think little more than 100%, and that is why we have taken the equity from 21.5% to 51%. Now, what has happened? Just in a tabular form, I'm showing you January 2020 equity portion was 40%, April 2020 it was 25%, and June 21 it is 51%. So if I compare the returns from January 2020 here to here, so the equity portion is up from 40% to 51%, right? And this is 27%. So he has gained 27%. Okay, there is no change in equity, and the proportion of equity has increased from 40% to 51%. Now another case, asset portfolio equity in January 2020 it was 40%, and he has decided that it should be 40%. So in April 2020 it fell to 25%. Now what he did, because it has fallen down much more from 40% to 25%, and he has reallocated the assets and he has increased the equity portion from 25% to 40%. Right now, what happens in June 2021? Because he increased in April to 40%, today it is 80%. Now that made the difference. How? In a tabular form, it will be much more clear. Now this is how it made the difference. In January 2020, it was 40%. April 2020, it was 25%. He has reallocated the money in his total asset portfolio and made it again, reset it again to 40% in equity. So now it is 80%. So what are the total returns? In January 2020, it was 40%, and now it is 80%. So the gains are 100%. That is the difference of making changes in your asset allocation. So if you have no strategy, then if you have not done anything, if you have not changed the portfolio allocation to various assets, then your gains are 27%. But if you stick to your strategy of 40% in equity, then your gains are 100%. That is how you have gained more, and now again you can switch back to 40%, because today the proportion is 80%. That is how you can protect your profits. Okay. There is one more poll. The right tool to measure the success of a stock advisor. What is the right tool? Is it the success rate? Success rate means how many stocks the advisor has advised during a certain period of time, and how many percentage of those stocks have hit the target. That is the normal rule of assessing the success of a stock advisor. Then second is IRR, that is the internal rate of return. From IRR, you may be getting confused, but in a very simpler way, it is the compound returns earned during last certain period. If the period is say 1 year or maybe around 2 years, but the number of advisors are more, then compounding is very, very difficult. Instead of that, you can use the formula in Excel of XIRR, and from there you can get the returns, or the number of clients advisor has, that can be a success measurement tool, or the qualification of the advisor. So as per you, what is the right tool to measure the success? So voting has started. You can cast your vote. There are 4 options. That is the success rate, IRR, or the number of clients, or the qualification of the advisor. Oh, only 10 seconds are left. I request all of you to participate. Okay. So here are the results, and rightly so. 53% of the attendees have opted for IRR, and there is a correct answer. This is the internal rate of return. This is the right measure of measuring the success of a stock advisor. Number of clients, maybe if that company is very sharp in marketing, then it can garner the more number of clients, and success rate is not the right tool. Moreover, if you ask any advisor, what is your success rate during last 1 year or maybe 14 months, then I'm very sure most of the advisors must have success rate of about 90%, because the market itself is up by 100%. So that is the wrong way of assessing the quality or the success of a stock advisor. Qualification of the advisor have, I think, a very, very low role in deciding the success of a stock advisor, because qualification is only a part requirement for the success of a stock advisor. And moreover, you will realize that most of the highly successful businessmen, the first generation entrepreneurs, are not qualified. Not even, I can say, not even, they have not passed even class 12th. So qualification of the entrepreneur has really no meaning in deciding the success of the business, and that should be the same in case of an advisor also, because as an advisor, he is advising you to buy a portion of the business. Yes. So more than the qualification, what is required is the basic understanding of the business, and also a big stomach to digest the ups and downs of the stock price and the market. So that was all about the tool to measure the success of a stock advisor. Okay, a bit more polls, and one more poll is there. The inverse of P ratio is, what is the inverse of P ratio? Is it net profit per share, or the earnings yield, or the PEG? There is a P to growth ratio, or the dividend yield. This is very interesting. This is a very basic about the P ratio. So now it is on your screen. You can cast your vote for the different options I have given. That is net profit per share, earnings yield, PEG ratio, or the dividend yield. The inverse of PE ratio. P stands for the price per share and E stands for the earnings per share. Well, time is over. So 61% of the participants have gone with earnings yield, and this is also the right answer. More about this we will cover in our forthcoming workshop. Yes, we are going to have a workshop and more details will follow soon. So this was the result. Net profit per share is nothing but the earnings per share, and earnings per share is EPS. So we are asking for the inverse of P ratio. That means the earnings per share divided by the price per share. So that is earnings yield. So we are going to take a very short, smart pause, and I'm going to make a very great announcement, much awaited from long time. And this is workshop, and we are going to organize a workshop. Topic is Topics may look to you very simple, but it is very powerful. That is understanding the P ratio. Yes, that is going to be the topic, and the details are like this. Objective is to empower investors to analyze stocks and project future share price on the basis of P ratio. On the basis of P ratio, yes, you can project the future uh, share price, but for that, you need to have a very clear and correct understanding of P ratio. Yes, myself A.K. Astani, and I am going to steer this workshop, complete workshop. I will be there with you, and I will show you everything and anything about the P ratio. What you are going to learn: the basics of P ratio, correct way of finding the P ratio. Yes, people are even not finding it in a correct way. Even on the leading websites, the P ratio shown is not the right way of calculating the P ratio. P as a tool to value a stock, yes, and how to project a share price, as we have discussed. P should be calculated on past earnings or the forward earnings. That also we shall cover. And is P alone sufficient to value a stock? Of course, not. P alone is not sufficient, but what are the other factors? That also, in brief, we shall cover. And why P is so powerful. Is low P better or high P better? And then what is the learning from the changing P ratio over the years? Over the years, I will give you an example like Hindustan Unilever. There was a time when the P ratio of Hindustan Unilever was 30. And over the years, it has steadily increased, especially so during the last 10, 11 years. And today it is touching 80. What does it means? So what you will get in workshop, of course, there's an online workshop, so physically you are not going to get anything, but definitely you will get an opportunity to ask all sorts of related questions with P and topics which we shall cover, and hands-on experience of finding P in at least 4 cases. You yourself will calculate in a right way, and also projecting the future share price for 4 cases. I shall share with you the key slides of the presentation which I am going to make, and this shall be shared in a WhatsApp group. An exclusive WhatsApp group shall be formed of all the participants, and this group will be for a period of 3 months. And also we are going to give you a surprise offer of ₹500 for those who attend the workshop. And then For whom? This workshop is for those investors who are interested in building confidence and conviction. As I said, the person who called me up, and he himself was not confident, and I'm very sure he didn't have much knowledge about the fundamentals of the company, but still he was not confident. So what should be the confidence level and how to gain that confidence and conviction? And that also helps you in building your emotions, in controlling your emotions, not building, in controlling your emotions. And also this is useful from educational point of view and very helpful for evaluating IPOs also. And of course, it is very natural. The outcome of about these 4-5 features leads to improvement in your stock investment returns. This is going to be a very unforgettable experience. Believe me, those who have attended my workshops, those groups are still there. The first workshop took place in Rajkot about 5 years ago, and that group is still there. So I do say that this group will be there for 3 months, but it will be there for a long, long time. And we are going to have a limited seats in this workshop. You can book your seat as early as possible, and it is available on, you can book through the website. On the website, when you reach to the home screen, on the top there is a Smart Academy. Under Smart Academy, when you take your cursor there, there will be a first icon, seminar workshop, and you click there and you can subscribe. And once you subscribe, we shall inform you about the modalities, about the basics of PE ratio. We shall send you some soft material also, so that you are ready with basic material. And the cost of this workshop is 1,500 rupees plus GST. So that comes to about 1,770 rupees. So that was all about the workshop. And this workshop is going to happen on next Sunday. That is 1 week from now. And the timings will be 9 a.m. to 9 a.m. to 1 p.m. with a break, one break of about 15 minutes. So continuing with our 4 ways to protect our profits. The first was the stock-wise allocation, second, the strategic allocation, and then the third, the tactical allocation. What is tactical allocation? This is strategy wherein we are trying to predict the market. Yes, that is very dangerous, and one should avoid. Nevertheless, you can tinker with the kind of stocks in your portfolio. That is what is known as the case scenario. If you are confident that there are 60% chance that the market will go down, then you can change your portfolio, move towards the bigger companies, move towards the less riskier stocks, like that. That is the tactical allocation. Also, you can increase the equity proportion or reduce the equity proportion. It all depends on your perception about the market direction. We at Smart VERC never believe in predicting the market. Of course, we believe in changing the stock qualities. Stock qualities in terms of the market cap, in terms of the safe sectors, like that. And the last one is rebuild your portfolio from scratch. What is that? This is going to be very interesting. If I ask you that you sell all the stocks in your portfolio, okay, today I ask you to sell all the stocks in your portfolio tomorrow, that is on Monday, and on Tuesday I ask you to rebuild your portfolio, and with no attachment to your previous. It is not necessary that you have to include only the previous stocks in your portfolio. Now what you will do, I am very sure there are many stocks in your portfolio wherein you would not love to have so much of weightage. Also, there are many stocks in your portfolio which you would not like to have if you are given a second chance. Yes, that is a hard truth. We keep on holding for various reasons. Maybe this stock has given me so much of profit. How can I sell it? But if I ask you that sell this and buy again, I'm very sure you are not going to buy in that high quantity, or maybe you may not buy at all. Similarly, you must be holding some stocks which are not in profits, which are in loss. Which are in loss means your purchase price was higher than the current price. If I ask you to sell those stocks and buy tomorrow, I'm very sure you are not going to buy. So those are the stocks which you should exit, right? So the best way of rebuilding your portfolio of thinking means one of the ways to protect your profits is assume that you don't hold any of those stocks. Then one by one, case by case, you try to understand that which stocks you will include in your new portfolio. And in a very simpler way is, had I not owned this stock, would I buy today? That will give you a very simple answer, right? And we do this for all our advice stock very frequently. Every 15 days, we revise our recommendations and we try to see that had we not recommended this stock to our subscribers, are we ready to advise this stock at current price? If the honest answer is yes, then hold it. If no, then make an exit. So this very, very powerful tool. So these are the all four ways to protect your profits, and you will appreciate that these are only to protect the profits. I have not discussed how to increase the profits. Those are the other ways. These are the ways to protect the profits which you have already made, right? Again, one more with the P ratio. Stock P compared to the industry average P helps in finding what kind of stocks. Try to understand. Stock particular PE compared to industry average P ratio helps you in what respect? Is it for growth stocks or for finding the undervalued stocks, or it has hardly any meaning? So it is on your screen. You can participate in this poll, and you should participate. It only enhances your knowledge, our knowledge. Stock P compared to industry P helps in finding the growth stocks or the undervalued stocks, or not much help. So only 10 seconds are left. Well, 78% participants have voted, and the results are like this. %30 say that it helps in finding the growth stocks. Definitely, this is not the right answer. And 59% say that it helps in finding the undervalued stocks. Well, if you look at the short term, I may say yes, but from the long term point of view, no. This answer is also not correct and not of much help. There are only 11% investors, and they are right. They are right. Yes, they are absolutely right. This does not show anything to you. I will give you an example. There is a textile company, suppose, and it is just a very plain type of textile company, and it also makes some garments, and it is operating from last 20 years and doing just average. And that sector has only few players, and one of them is Page Industries. whose PE ratio is 60. Now, because of the Page Industries, because it's a big company, its P is very high, 60, and rest of the sectors, rest of the players have a P ratio of ranging from 15 to 20. Now, if you compare the P ratio of your company, whose P ratio is say 17, with the sector average of say 50, it does not means that your stock should also command the P ratio of likes of Page Industries, because Page Industry is a different in a different league compared to the rest of the players who are way behind in terms of value addition. So this is just one example. There are many other examples also. Suppose in steel, there are few very big players and there are many other small players, and the P ratio varies hugely from 6 to 21. Now, you cannot compare any small company with a P ratio of Tata Steel or JSW. But because most of them are big players, the P ratio of the sector as an average will be way high. So that is the uh, reason why it is of not much use. I will show you with one more, a small presentation, but I've shown this last year also, and this is very useful and very effective way of looking at the P ratio. Before that, I want one favor from you. There may be, I think, about 15 to 20% of the today's participants which are attending this webinar for the first time. So if they, so as I said, we have made city-wise groups. We have made city-wise WhatsApp groups, and in these groups, these are only admin controlled. Only not more than, I believe, on an average, not more than 2 messages are shared, and that too from the admin sites. So it is not going to disturb you. Those who are interested in participating, in becoming a part of this group, they can send us their request on our WhatsApp number, and that WhatsApp number is 9755920780. So just another way of showing you what happens when we compare a stock specific P ratio to a sector average P ratio. So here is the, on x-axis you can see the increasing P, and on y, oh sorry, this vertical axis is, y-axis is increasing P, and x-axis is declining quality of earnings. And there are 3 category of stocks. A, which has a high P and the quality of earnings is pretty good, I should say very good. And then there is a stock B, which has a average P ratio of sector average P ratio, and its quality of earnings is just average. And then there is a C stock whose quality of earnings is low, and hence logically it should command a low P ratio. So these are the 3 stocks. And this yellow line, what you are seeing is the average, sector average, right? Now what happens? It's a very interesting case. There will be a story somewhere in the media, somewhere maybe in the television or maybe in the print media, or maybe some advisor says that the sector average is this much high and this C category stock is ruling at half the P ratio of the sector average, and also some other stories will be built up that this stock deserves a better P ratio, and maybe in the course of time multiple channels will show the same story or the same stock, and what happens is this stock moves up, share price moves up, and it comes in line with the sector average. But as the share price of this stock moves up, the P ratio, average P ratio also moves up, as shown by the black line. Black dotted line is the new sector average, yellow line is the original sector average. Now the C stock has moved up, Its P ratio is up. Now people are happy. Advisor is also happy. So everyone is happy, right? Subscriber is also happy. Other investors are also happy. Now what happens? There will be another story for a B stock. It will try to compare with the industry average because industry average has moved up, sector average has moved up. Now this way there will be a story for this, and it will try to compare with A, P ratio, and there will be a great story about the company's prospects or the industry prospects, and this also moves up. Share price, it comes in line with A. Average sector P also moves up as shown by the black dotted line. And now a story will appear for A that if B and C category stocks are commanding such high P ratios, then A deserves premium valuations, and A also moves up. So this is very interesting. A has moved up, B has moved up, C has moved up, all the three. That means the whole sector P ratio is up. I have not spoken about the financial performance of the company. Without financial performance of the company, all the three stocks have moved up. The sector average has also moved up. Now you will realize that everybody is happy. But then without improvement in the financial performance, there must be someone who is losing. Who is that loser? Isn't it? Without improvement in the financial performance, just on the stories, the sector average has moved up, and this cycle keeps on repeating. Yes, original P ratio, sector average P ratio is here, yellow line, and black line moves up and up and up. Many a times, financial performance may not rise to that speed with which the P ratio is rising. Now you will understand that what happens. Ultimately, what will happen? What is this happening? If without much improvement in financial performance, P ratio keeps on improving, what does it mean? It means a formation of a bubble. Yes, that is what happens. It cannot happen that you can keep on comparing with the average sector and keep on moving the stocks, and all the stocks are moving up. There is no follow-up in earnings growth. How long this can go? The day will come when this will again reset. Not only reset, but it will go down even the average, original average of the sector. And then most of the investors will say that, yes, I got an opportunity. I was just about to sell the share, but the market fell and I could not complete my trade. But अभी मैं इंतजार करूंगा, वो प्राइस फिर से आने दो, इस बार मैं चुकूंगा नहीं, एंड आई एम वेरी श्योर इस बार तो मैं सेल करके ही रहूंगा. That is the mentality of a retail investor. We should avoid this. This is not the right way of using a P ratio of stock versus the P ratio of the sector. So this was all about the small wrong usage of P ratio. This is a very apt quote by Charlie Munger, and he is a partner of Warren Buffett. What he has to say: bull markets go to people's heads. If you are a duck on a pond and it's rising due to the downpour, you start going up in the world. But you think it's you, not the pond. जो बतख होती है, बहुत सारी बतख जो है एक पॉन्ड में स्विम कर रही हैं, और आपने देखा होगा कि वो अपना पैर चलाती हैं, थोड़े पंख भी चलाती हैं, और इसी बीच बारिश आ जाती है, और बारिश के कारण पानी का लेवल ऊंचा उड़ जाता है, और वो बतख भी, क्योंकि पानी का लेवल, पॉन्ड का लेवल अप हो गया है, तो वो बतख भी अप हो जाती है, और उसको लगता है कि उसने जो एफर्ट लगाया उसके कारण वो ऊपर आ गई है. बट द फैक्ट इज वो बारिश के कारण ऊपर आई है, ना कि अपने एफर्ट्स के कारण. एंड दैट हैपेंस इन स्टॉक मार्केट. व्हेन द मार्केट्स गो अप, everyone starts thinking that he is smart, he is able to find out the way to create wealth from stocks. And in most of the cases, it is not the individual's expertise, it is the whole market. Whole market is going up. It is not your effort. The simplest thing is from March 23rd, 2020 low, market is up by 100%. Now you look at your portfolio, what risks you have taken and how much gains you have minted. That will show you what was because of the market and what was because of your capability. And that is known as alpha in stock market. मैं और ज़्यादा आपको कंफ्यूज नहीं करना चाहता हूँ अल्फा को लेके. There is another very simple thing. Profits in the stock market that come easy will not last long. Yes. And that lasts will not come easy. It looks very easy. And for most of the retail investors, it is not like that. So be very careful with the profits. So with this, we have come to the end of the presentation. Now we are going to start question answer session. You can write your question in the chat box, or you can raise your hand via the I think there is a reactions button on your screen. You can use that. Thank you very much for sparing your valuable time. To subscribe SBP service, okay, I am reading a question from the chat box. To subscribe SBP service, how much initial capital is required? How it actually works? Can you send a minute on this? All right, I will send you the details. And SBP is a part of Smart Gains only. So if you subscribe to Smart Gains, you will have an access to SBP. And as such, there is from our side, there is no such limit on how much money you should have to participate in SBP. And you can, presently its value is 1.1 crores. So you can invest in multiples or in divisors. It is all up to you. Sir, weightage with respect to total initial investment. When I say weightage means with respect to the portfolio. Yes, if you are talking about the initial, yes, it is with respect to the initial weightage with respect to the portfolio. Long-term view on NBFC companies. Long-term view on all the stocks depends on the particular growth strategy followed by that company, and also the prospects of that company with respect to the how the CEO is enterprising, what actions he is taking, like that. I will give you an example. In Bajaj Finance, this company is into existence from last so many decades. Yes, it is not a new company. It is a very, very old company. I hope you all remember that whenever we used to visit a Bajaj Finance, any shop, especially white goods, we used to find a person sitting on the table with a small wooden in this thing written as Bajaj Finserv, and there was a symbol on that. And that company was not doing any special, and that company was just its profits were hovering sometimes up, sometimes down. There was no clear trend till 2008-9. Yes, till 2008-9 there was no trend. So that was the one time when you ask me Bajaj Finance, I will say, okay, this is just an okay company. But if you look at the profits trajectory, the income trajectory from 2009-10 to till date, then I can say that yes, it is a growth company. It is a highly enterprising promoters are there and like that. So company is same. What happens is the story not only about the sector but also about the company. There are very dumb type of sectors, but there are very enterprising investors, enterprising companies in such dumb type of sectors. So that is where we have to look for. We have to look for more about the company rather than the sector. What should be the top 2 reasons to sell any stock? Okay. To sell any stock, there are, if you ask for top 2 reasons, one of them is the stock has become overvalued. Then you have to sell. Overvalued, when I say overvalued, means what is the intrinsic worth and what is the current price. If the current price is here and the intrinsic worth here, it's time to sell. Secondly, when compared to its risk profile, that stock weightage is commanding more weightage in your portfolio. So as per the risk profile, as per the risk return profile of the stock, if it deserves about 5% weightage in your portfolio and you are holding at 11%, then it's time to prune down its weightage to 5% or 6%. Given that interest rates will increase in future, how do we foresee banking and financial stocks perform? See, what these banks and financial companies do in lending business, what they do. They are getting funds from one source and they are distributing funds to another source. They are enjoying the in between margins. Suppose if they are able to get loan from international market at the rate of 4% and they are giving you at 7%. So the difference of 3% is the profit. It is not the whole, is not the profit. Of course, they have also some expenses. So that is how they are earning their profits. So whether the interest rates goes up or down, their margin is almost intact. But when the economy grows fast, they have more funds at their disposal and more profits. But the economy slows down. When the economy slows down, then the profitability squeezes. So that is the way it works. So there are, I can see a couple of questions regarding a particular stock recommendation. I'm very sorry. If a company has 5-year average CAGR growth of 25% in profits, what can be maximum justifiable P? This is very interesting and very smart question, I should say. If the growth of 5-year CAGR is 25% in profit, then I can say that justifiable P is about 35 or maybe even 40. I am ready to pay a P of 40. So this was all about the questions from the chat box. Mr. Sriram Gopal, kindly unmute yourself.
Hello, sir. Good evening.
Good evening.
I have been your this thing only for the last 2 weeks, and I miss. I mean, the day when I don't have your Sunday session, I go and ask your group whether we have one. So I'm so addicted to your session nowadays. Thanks for that. And probably my question is around. I mean, stock specific. I don't think you encourage. But how do you see chemicals or pharma as an industry, sir? I think by valuations wise, they were very less before COVID, and now I think it has all caught up. Or do you further see any room for chemicals or pharma?
Okay. Yes, as you said, in chemical and pharma, the P ratio was, especially in specialty chemicals, the P ratio was pretty attractive before COVID, but now the P ratio is high. And pharma also, because during the COVID, many companies were engaged in producing in some way or the other the raw material or the finished dosage form of the medicines used in COVID. So that is the reason why the performance also came pretty good. As on date, I am a bit worried about the pharma companies' P ratio because this trend cannot go long. And moreover, the demand for the pharma products is not elastic. So it is not economy driven. Regarding the specialty chemicals, yes, even some of the very good companies, they are commanding P ratio in excess of 60, which is very difficult to sustain. But at the same time, there are many US-based, especially US-based large corporates which are tying up with the Indian companies for very, very long term. And similar case happened recently with a company named as Heikel. So in specialty chemicals, I would recommend to reduce the weightage, but not sell altogether. It again depends from case to case basis, but in general, my advice would be like this.
So sorry, sir, I missed what you said in the last statement. What was the company you said? I mean, there was a tie-up.
There are good companies, but those companies are commanding high PE ratios in the range of 50 or 60. So I would not recommend you to sell altogether, but you can reduce your weightage like that.
Okay.
Yes.
If I'm going to add on only chemical companies now, is it good to add 2 to 3% to the portfolio?
Yeah, minimum we recommend about 3%. And you can add, there is nothing wrong in it. It is only case specific basis. All chemical companies are not good. So on case to case basis, yes, you can have an exposure of about 10% of chemical sector in your weightage.
Okay, thank you.
Thanks. Mr. Puneet Mathur, kindly unmute yourself.
Sir, very good evening.
Good evening, sir.
Sir, just like to know about the outcome or like what is the future for that textile stocks. We have seen a rally in textile stock. I'm so sorry, I'm joined late. I just occupied in some work which I just forgot. If you have already spoken, I'm so sorry about it. But my question is just about textile sector. Why it is going up and what is the future of it, sir?
See, due to COVID, there are I can say every week or every fortnight, there are big changes happening around the world. Not only around the world, even in the domestic market. Sometimes some sector prospects appear good, and others sector prospects appear good because of the change in the raw material prices, because of the change in the demand. What was good in terms of the plastic companies just 6 months ago or 9 months ago is not good today, because the crude is very high, raw material prices are very high. So the situation has become very, very dynamic. So I cannot, even in textiles, there is a good demand from the US markets, and you will find that most of the export oriented textile companies, they are doing very well. Their share prices are doing very well. And also because of the advantage of the raw material. How long this advantage will be there, I can't say. So be very careful, because in general, textile companies don't command high P ratios except for a couple of companies.
So like better to stay with the leaders like Raymond's or Grasim in that case, because we have seen some small companies giving 20% back to back. I don't know how come like few like companies like Rupa, VIP, all of a sudden has given such a return, such a huge returns, and I can't see any other thing. Like, what is that? There's no such change as such which is observed. So I better to stick with that companies which are old and sort of a blue chip companies, or any other ways like you think in this sector.
Sir, as I said, don't try to compare with others. That advantage can be there in the very short term, but in the long term, no, that is not the way to pick the stocks. Maybe where the Grasim is engaged in some synthetic textiles, and if you are trying to compare with some man-made textile company, then there is a difference in that. It is not that easy to compare, and it has to be on case basis. Yes, if you say that the Rupa or Page Industries has done well, then it is maybe because of the results. And if you compare their performance for the last couple of years, not for the immediate quarter, but for the couple of years, that should be the right way of selecting the stocks.
Okay, thank you, sir.
Yeah, thanks. Mr. Lalwani, kindly unmute yourself. Yes, sir.
Hi, Sanji.
Yes, sir.
Yeah, I have two questions here. One is regarding the asset allocation. So you said that like whenever we are doing asset allocation, we should include our property also. Things like property, like some 10 to 15% of property and gold. So in terms of property, the house in which we are staying, so should we consider as asset or should we not?
It should not be considered in that portfolio of your assets. The house where you are staying should not be considered.
Oh, thank you. And the second question I have, you said that like only P ratio is not, like we should not consider only P ratio for stock selection.
Yes.
So like if you can tell like other than P ratio, like 3, 4, 5, 6 factor which we should consider. So what are the other 5, 6 factor which we see when we choose the stock?
Sir, it all depends on case-to-case basis, whether the company is exporting company. If it is an exporting company, then our currency movement with respect to that export destination, that also comes into the picture. And what kind of debt it has, that also comes into the picture. And also, the main thing is the story. Story means the promoter, how he foresees, how he is building the strategies for taking the company forward. So these are the things which are mainly subjective. P ratio is purely objective type of things. So there are it all depends on case to case basis whether that company has taken a huge expansion in the past and it is going to complete in the recent uh, coming months. That also gets considered. For example, I will give you an example. Like in GSW Steel, they are going to expand their capacity by 40%. Maybe in the coming 6 months or maybe in the coming 9 months, they are going to complete that. So I'm not recommending the stock of GSW Steel. I'm just giving you example that if you are targeting investment for 1 year, then you should consider that also. P alone will not help you. You should also know that you're comparing with, say, Tata Steel, and just assume that Tata Steel does not have an expansion plan or they are not undergoing any expansion. So you cannot compare GSW with Tata Steel based on P alone. You have to take into consideration expansion plans. So it is
Other
all
factor.
case to case basis.
Okay. Yeah, because like why I'm asking this question, in India, I don't have any worry. Means I know in India, I'm following you. So whatever you are suggesting, I'm simply putting my money there. But in US, I'm not getting a proper advisor. So that's why I'm trying to learn.
Okay. Thanks.
Thank you.
Thank you. Welcome. Mr. Anuj Singhal, kindly unmute yourself.
Good evening, Mr. Asnani. Am I audible?
Yeah, good evening, sir.
Mr. Asnani, I have two questions. First is regarding this strategic allocations. In this PPF and the sovereign gold bonds are to be taken towards the allocation or not? Because they may not be able to be switched off.
Yes, it has to be into the consideration.
Okay. And my second question is about the story building up. I have heard your conversations, I think, 2 weeks back, where we were discussing about sugar industry.
Mm-hmm.
And you yourself had told that sugar industry is quite regulated, so you don't have any recommendations for it. But since now the ethanol story is building up, is there any change in the views? You'll be having some change in that strategy, or we follow the same thing? Thank you.
No, our views are same because in sugar industry, even the raw material as well as the output is mainly controlled by the government. And secondly, regarding the ethanol story has built up, I think, at least 3 times during last 6-7 years. And whenever the crude goes up or whenever the petrol prices go up in the domestic market, this ethanol story builds up. And as soon as the crude subsides, goes below $60 per barrel, and everyone forgets about the ethanol story. This has happened 3 times, at least 3 times to my knowledge during last 5-6 years. So be very careful with this story. So why not to bet upon the companies which are undervalued, which are in a better position rather than the uncertainty being faced by such sector like sugar sector. So that is that would be a more, there will be more a safety margin in other sectors compared to this sector like that. And also there are not many good players in the sugar sector. There are very limited good players, so it is really very difficult to uh, play in this sector. If you have the access, if you are able to value the stocks, if you are ready to take the kind of risks or uncertainty it involved, you can have a weightage of 4 to 5% of the sector in your total portfolio. That would be my advice. Mr. Mahesh, kindly unmute yourself. Yes, sir. Mr. Mahesh. Mr. Atul Chote. Mr. Atul.
Yeah, good evening, sir. First of all, congratulations to your achievement of 1 CR before 20 years. Sir, my question is about the cash flow statement. Most of the companies are declaring the numbers and the profits are not included in the cash flow statements. It means that they are showing the accruals income and that is blowing the profitability. But the cash flow is not improving and discounted cash flow is not that much good. So many investors are trapped in this kind of a companies. Similarly, one of our friend is asked about the textile sector. Similar story is built up in the long means very old company about the, I can say that Raymond. So that is also the same story, I think so. Can you just elaborate that, sir? Or can you just guide on this?
Sir, I request again and again that we cannot discuss about the very stock specific queries.
Sorry for that, sir. So, no. I'm just asking for the discounted cash flow and the cash flow statement. That is my query.
The best way we look for the proxy for the cash flow statement is the dividend. If the company is declaring about 25% of their profits as dividends, then it has a reasonably good cash flow. That is a thumb rule which we are using, and you can also use that. And because dividend is the only cash which flows from company to the shareholders, and without being a cash rich company, it cannot declare dividend for continuously for many years. So that is the best way we use. And also, as I keep on saying that, look for any company. What has happened in the past? That will show you the story about the promoter, about the CEO. Is he or she enterprising or not? Like that. Maybe brand may be very strong, but if the company is not enterprising in nature, then slowly and slowly that brand will get killed. There are many examples happened in the past, and we all know how the brands simply vanish.
Okay. Thank you, sir. Thank you. Yeah.
Okay. By the times in the chat box, somebody has written, by the time Smartian advice reaches me, mostly it's around 2% above advice price. Should I still buy or not? Yes, sir. If you look for the frequently asked question, there we have mentioned that even if the stock is up or down by up to 3%, you can buy that stock. Nothing wrong in that, because we are targeting at least 25% returns, annual returns for any specific stock. Even if you have lost 2% or even up to 5%, then also there is nothing wrong, because we are able to get much higher returns than what we are targeting. And even in our SBP itself is delivering 26% from last so many years, to be precise 20 years. So there is nothing to worry about 2% here and there. It happens. Maybe at times you might have observed that you are able to pick our advised stock with a 2% downside also. So it is only a matter of time. And currently we are all passing through a very strong bull phase, I can say. So that is the reason why, not often, but yes, at times it happens. Mr. Rajesh Jagwani, kindly unmute yourself. Yes, sir.
Can you hear me?
Yes, sir.
Hi. In the current scenario, do you sense that there is a sign of bubble formation?
Your voice is not clear. Yeah, tell me, sir.
Do you see any signs of bubble formation in the current scenario?
Sir, there is some issue. Can you write in the chat box? I'm not able to hear you properly. Please. Mr. Mahesh Agarwal.
Good evening, sir.
Yeah, welcome. Good evening.
Sir, I have a query. In one of your quotes, you said that if I'm not ready to buy this stocks at current price, I should sell them.
Yes.
Okay. But sir, if I'm just, for example, I'm holding Reliance Industries, and at present it is at slightly giving me some loss, 2-3%. But I'm confident enough that in near future I will have at least booked this stock. So should I hold it?
Sir, what I said is like this. Irrespective of your buying price, if I ask you to sell today you sell Reliance, okay? And will you buy tomorrow the Reliance at the current price? If the honest answer is yes, say you said that you are very confident. If the honest answer is yes, then you should hold that stock. That is my what I meant from that quote.
Okay, sir. But in this case, I will not buy Reliance at current price. But I still do not want to book loss because I am confident enough that it will rise at for the much magnitude that I will not have to book loss.
Sir, I am not asking you to book loss.
Am I clear?
What I am saying is, if you sell today and tomorrow, will you buy the same stock again, or you have got some other better stock in your to be included in your portfolio? It is like this. If you are tomorrow also you are going to buy the same stock, then don't sell today.
Okay. Thank you.
Mr. Mahesh, kindly unmute yourself. Okay, in the chat box, do you see any signs of bubble formation in the current scenario? Bubbles will always be there. It has to be seen with respect to the very stock specific. Stock specific, yes, there are lots of bubbles I can see. Without any fundamentals, without any performance improvement, share price is up by 3 times, 4 times, 5 times, even 10 times. So those are the bubbles. What is bubble? Bubble means a stock which is worthy of say 100 rupees and it is quoting at 200 rupees. So that is a bubble. Bubble means overpricing of the stock, overpricing of any asset. It can be any asset. So, and such scenarios are always there, whether the market is down or up. But when the majority of the stocks move in the bubble region, then you say that the total scenario is like that. But you cannot predict about the market. Don't make a decision based on the total market scenario. We keep on saying that be very specific with the company you are owning, not with respect to the market. Don't try to predict the market. No one said on 20th of March that 23rd March will be the lowest. No one said on 1st of April 2020 that market will rise 100% from here in the next 1 year. No one said. So no one can predict. Forget it. No one predicted second wave as severe as it has happened. Could anyone predict? No. So don't try to predict the market. Always bet on the company you are invested, bet on the CEO of the company. He will find the ways, whatever will be the market scenario. When I say in this case, market means whatever is the economy. The CEO of the company will try his best to give you the best returns. Yes, it is the duty of the CEO. I'm betting on the CEO. I'm not betting on the market. So with this, we come to the end of today's session. Yes, Mr. Ashish Diwan, kindly unmute yourself.
Yeah, good evening, sir.
Yes, good evening, sir.
Sir, which are the sectors at present moment you look forward to? Which will you think that they will come up?
Sir, we never look for the economy. Even for the sectors also, we are not much concerned. Ours is a bottoms-up approach. We look for first the company, then the sector, then the economy. But in most of the cases, we are solely concentrated on the company. So, yes, if the company has the potential, I will give you an example. Page Industries is in textile sector, but if you look back for last 10 years or 20 years, there was no time, there was a boom-like conditions in the textile sector, but there was a company, Page Industries, which created a place for itself. And people got multiple returns, mega returns. So we have to be very sector specific.
So that is what I'm saying. Which sectors?
Not sector, very company specific, not sector specific.
Sir, I'm talking in reference with the current government announcements and the overall global scenario.
Sir, that is what I'm saying. Whatever the government announces, whatever is the global scenario, if the CEO of the company is smart enough, he will find the ways for the growth of your company. You need not have to bother about the government steps, because all those will be same for all the companies in that sector. So whoever is smart CEO, he will find the way and he will get you the returns. So for example, I give you then Bajaj Finance. You have seen that what has happened during last 10 years. Whatever may be the scenario, they are finding the technology, they are finding the way to move ahead.
So, I am talking in reference to suppose now the credit growth has gone up. RBI has flooded the market with money. Money has reached the banks. Okay. Now the second step, it would be reaching to the consumers. The credit growth will happen. Manufacturing sectors, consumer sectors, like that. So there has to be a push from the from the global and the government forces to push the sectors, and the current will definitely go down.
Sir, every has a different opinion and different logics. What we follow and how we have achieved 26% CAGR is based on bottoms-up approach, and that is what I am saying. If the government has reduced the taxes, then it is beneficial to all. If the interest rates goes up, it will hurt the total economy, but there will be ways where the company CEO will find how to grow. During last 10, 11 years, Bajaj Finance has grown. There are many challenges during this time. It was not that this growth was very smooth, but why was only Bajaj Finance which made up? Why not the other NBFCs?
Okay, sir. Yeah.
That is my point of view. And ultimately, that is the only way. Means even that Warren Buffett, he is holding Coca-Cola from last, I think, more than 40 years. So there may be many recessions. Many times, people must have thought that now people will drink less of cola and less of Coke. So sell this stock, but he kept on holding it because he has the confidence on the management. He has the confidence on the brand. That come what may, they will find the ways to introduce new products, introduce new strategies like that. And there was recently an interview of even Bajaj Finance CEO that wherein he commented on the financial technology companies. So that is the confidence one should look for. It is not only these statements are not enough. You have to value the stock also. You have to compare the ruling PE ratio with the growth rate, expected growth rate in times to come. What has happened in the past and all those things you have to take care.
Okay, sir. Thank you.
So with this, we come to the And 1.5 hours is already over and no more questions, I see. Thank you very much for sparing your valuable time. Thanks.